Welcome to Daily Fortune, where we talk about the latest topic about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so that you'll know when I upload new videos. Now, let's get started. Are you prepared for this year's market crash? Let me tell you the truth. Stocks and cryptocurrency do not go up in a straight line. Being amid a worldwide pandemic where stock valuations are at all-time highs with a possible pension crisis coming, the global economic situation has never looked this bad. For a long time, I've been saying that the issue is that markets are unpredictable, and be prepared because this year we may see new all-time highs. Today's video will show why stocks and cryptocurrency could lead to a massive crash, the bear market case, why stocks and cryptocurrency could set new all-time highs this year, and the bull market case. Then, most importantly, you'll learn how to prepare to gain regardless of which direction the market moves. There is only one simple thing that you can do even if the market goes up or there's a huge crash, and that you can still win. You may be wondering how. How is that possible? Stay tuned until the end of this video to know that you shouldn't fear the market crash again. So let's first look at why so many individuals predict a market crash. Here are the 3 important facts that must be addressed. First, is that corrections occur every year on average. A correction occurs when the market declines between 10% and 20%, which is quite typical. Second, a bear market occurs every 4 years, and this is where the market has plummeted by more than 20%. Lastly, whenever the stock market has experienced a crash, it has always recovered and established new highs. This is true of the stock market in the United States. This is the S&P overlaid on the back. It is certainly true of the UK market and Europe. The only place this hasn't happened is in Japan with the Nikkei. But in its 200-year history, the US stock market has always recovered and reached new all-time highs after every single crash. The bear case. The problem is that traditional valuation measures show that the stock market is considered overvalued. As Warren Buffett put it, the Buffett indicator is perhaps the single best indication of where valuations stand at any particular time, and it divides the stock market's value by GDP. Thus, this goes back to the 1950s, and the historical trend line may be seen here. Now, once this goes above 100%, we've seen significant crashes like the dot-com crash and the 2008 financial crisis. And where we are currently, it's skyrocketed and is now at 218%, indicating that it's tremendously overvalued. PE ratios, which are stock prices divided by earnings to determine how much profit they're truly producing, are another excellent approach to value the market. So if the reading is high, it suggests the stock prices are high in relation to the amount of money the company makes. When it reaches new lows, it's an excellent opportunity to buy because stock prices are low compared to what the companies are making. We see a major peak here, measuring out at 30 shortly before the big 1929 stock market crash, and this goes back to 1880. As you can see, there was a crash here in the late 1960s. The greatest reading on the chart was the dot-com bubble, where it was approaching 45, and this is where we are now. So valuations have only ever been this high once in almost 100 years. The final catalyst is pensions, and what this has to do with demographics. Well, the youngest generation is Gen Z, followed by millennials, Gen X, the baby boomers, then the silent gen, and then the greatest gen. However, this has everything to do with the baby boomers. They were one of the largest population bubbles in history, and it is in their generation that the majority of wealth is held. Why? They've spent their entire lives accumulating assets and increasing their wealth, and they've been contributing to their pensions on a monthly basis. The majority of that pension money is invested in the stock market, resulting in large fat nest eggs. The problem is that they are now starting to retire, and they will require access to this pension fund. So what happens when millions of individuals begin withdrawing money from the stock market? The stock market begins to decline. What happens to baby boomers when their treasured retirement fund, which they've worked their entire lives to establish, starts to shrink? As more people become concerned, they begin to withdraw even more money. This causes a snowball effect which can lead to a crash. So with stocks starting the year already expensive and this large pension drawdown issue, it's no surprise that many experts are predicting a big crash. But what about the bull case? Let's look at why 2022 could be another record-breaking year for the markets. Let's move on to the bull case. There are 3 reasons we could establish new all-time highs this year. The first has something to do with the pandemic. According to germ theory, the virus aims to propagate to the next host. Therefore, killing individuals is detrimental to the infection. And if it kills individuals, it also kills the virus, which is why it usually evolves into less lethal variants, but more contagious, which is a win-win situation. We may let the virus spread through the population, giving us all the necessary immunity, and finally overcoming the epidemic and returning to normal life. This would be beneficial to the markets. For the second point, we have a money printer pal, and there's a fair case to be made that whatever happens in the markets, the money printers will keep printing us out of problems. We've printed more money than at any other time in history during the last big scare, and there's no reason to believe that this won't continue. And lastly, the third reason has something to do with technology, and anyone who knows Cathie Wood knows that she is currently one of the top money managers. Her theory is that we now have the convergence of 5 major technological advancements in blockchain technology, genome sequencing, robotics, artificial intelligence, and energy storage. We will witness exponential growth in the markets over the next 5 years as a result of these major innovations all coming together. So here's the million-dollar question.
So if you're ready, let's go for the million.
Will the stock and crypto markets fall or have another record year? Well, the world's greatest investors have only one thing to say. They all admit that they don't know where the market is heading in the short term, including Warren Buffett, Ray Dalio, and Jack Bogle. They've never encountered somebody who can consistently anticipate the direction of the market. This means that any television interviews, podcasts, or YouTube videos claiming that the stock market is likely to rise or fall is all just noise. This is a portfolio that is 100% invested in the stock market. If the stock market rises, you'll reap the benefits. However, if there is a market crash, being 100% invested in the market does not provide any protection. On the other hand, many have chosen to remain completely cash-based. Now, if there is a large crash, you'll be able to capitalize and buy stuff when it happens ultimately. They're on sale, but if the crash never occurs and stocks and crypto continue to reach new all-time highs, you'll completely miss out. So, what do we do now? One of the best ideas we could learn comes from Warren Buffett, the world's greatest investor, and his company Berkshire Hathaway. And this is how his portfolio looks. He has a massive $293 billion invested in the stock market and $150 billion in cash equivalents. In this scenario, it's T-bills, or the treasury bills, which are short-term government bonds. At the moment, you only earn about 0.25, which adds up if you have 150 billion, but not for somebody with less than $1 million. It's not that dissimilar to simply being in cash. As his famous saying goes, you should be fearful when others are greedy, and greedy when others are fearful. And yes, this is how you win either way. As the stock market rises and continues to set new all-time highs, you're making a lot of money. And if there is a big stock market crash, you have the capital to deploy and buy things when they are at their lowest prices. Warren Buffett has never had this much cash ready to deploy in case of a market crash. Finally, as a bonus for those who want to pursue a higher risk, higher potential reward method, it's relatively similar. Still, you'd be largely involved in the crypto market, with all your cash equivalents being stable coins. As an investor, all you have to do now is choose when you want to start buying back in. Another excellent and established method is to just dollar cost average every month no matter how much money you have, regardless of what might happen. You'll be buying down and purchasing up this way, and it's a terrific tactic to go back up. Not by being fully allocated in the market. You get peace of mind knowing that your money is completely invested in the market. Whatever happens, you'll come out stronger in the end. Warren Buffett has made some of his most significant investing profits after a crash, and he has one of the strongest crash protection techniques. And that is how you may profit in any scenario. If the market rises, you can profit. If the market falls, you can still profit. You can also profit from a major market fall. All you need is the patience to wait for the market to recover. Yes, all you need to do is lengthen your patience. Finally, there is one final issue to consider for everyone who is nearing retirement. As you won't have the luxury of time to recover, you may wish to take some chips off the table and move into some safer investments that won't crash. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, please don't forget to hit the notification bell. See you next time!